Assalamu alaikum, ladies and gentlemen. This is Khurram Zaheer Chishti. I am a FRM charter holder. I'm FMVA, Financial Modeling Valuation Analyst. I am CBCA, Certified Banking Credit Analyst. I am SCR, Sustainability and Climate Risk from GARP. And I'm a AFM Advanced Financial Modeler as well, beside being a BBMBA from IBA. This is the second lecture in series of Basel lectures based on Basel II, but I have divided it into two parts, part 1 and part 2, because of the length of coverage of material that it entails, and because I want to do justice to the content and to convey the correct understanding to the audience. Now, how it is divided into part 1 and part 2, I will just tell you as we proceed in the lecture. And basically, this is the second lecture. My first lecture on Basel was on Basel I. This is Basel II, and Basel II I've done in two parts. Part one, which covers the standardized approaches and internal rating based approach, and the other approaches on operational risk as well as a market risk, as well as pillar 2 and 3 will be discussed in the next series because of the coverage and the time duration for the lecture. So we will proceed with Basel II. Okay, first of all, why was the Basel II introduced? Why was it felt? Why wasn't Basel one just enough, and why wasn't it good enough? So, as the as was told in the last slide, Basel one was introduced in 1988. Then come early 90s and come early mid 90s. There were more banking products became more sophisticated. There were more products, particularly with respect to derivatives, that came around. And Basel one, the limitations as shown, the limitation prevailed. First of all, was regulatory arbitrage. There were certain areas and there were certain banks which had or certain geographies which had lenient regulations with respect to the capital and the how the treatment how because Basel one allowed some banks to adopt some approaches with respect to how they record the mark to market and how they record the derivative exposure. There was a regulatory arbitrage. People in one geography, one would benefit, and the other geography, there would be stricter laws, insufficient sensitivity. As was told in the last lecture, Basel I treated all the corporate exposures the same. There was no difference between a top tier corporate and a one with less degree of financial and operating history compared to a full-fledged large-scale business. So there was insufficient sensitivity involved, limited risk focus. It only focused on credit risk, not on market risk, not much on market risk, and definitely not much on operational risk. And one size fits all approach, as it just says, 8% of the RWA was given a certain percentage of your exposures to convert them, and then this was applied. So it was almost like it did not differentiate between the credit risk. So it was one size fits all. Then regulatory two framework, it came just opposite. In contrast, it filled the missing parts of Basel one, whereas it had risk sensitivity. It started differentiating between blue chip companies in the credit risk space and the SME companies with less degree of operating and financial history. It differentiated between what we call Microsoft. It differentiated between Google and a lesser known name and a lesser credible name. So it gave you that sensitivity. Operational risk, Basel one introduced pillars, one of them exclusively devoted to operational risk, how to calculate it, and this operational risk aspect we'll discuss in the next subsequent video. Risk management, as has been said, rewarding banks for using internal models to improve practices. It gave the banks the liberty to develop their own internal models. So hence, risk management was not just a good to have department. Once it came, it became a forefront, and controls became as important, if not more, than revenue generation. Regulatory arbitrage, again, because it had measures which we will discuss in subsequent slide, that regulatory arbitrage was reduced, though not eliminated. And of course, market discipline, which refers to the disclosures that are required. You have to keep the stakeholders into confidence. You can't just do, you have the stakeholders' money. Whatever you do should be disclosed in a transparent, crisp language to the disclosures. Also, there need to be a supervisory, central bank had to supervise on the bank, so that element was also there. Then Basel II development type pipeline, how did it come around? So, as I said, 1988 the Basel I came. Then there was some other incident that took place in 1995. The barring bank had defaulted. A couple of banks had defaulted. New products, particularly through derivatives, forward contracts, future contracts had come into place. So 1999, so there was a need felt to revise the Basel I, and this how it happened. 99 first consultative issued by BCBS. Then second consultative paper published and underwent certain amendments, and certain 21 amendments. And in 2003, the final version of the Basel III was released. 2004, it was revised version was issued, and 2006 to 2008 final implemented across the various countries. So these are the very famous how the pillars work in Basel. As I said, Basel One is the minimum capital requirement. Basel Two is the market supervisory review, which involves the central bank telling what to do and what not to do, and then the market discipline, which is the disclosures part. We will cover the supervisory aspect and the market discipline in the subsequent lecture. So here the Basel One capital requirements for banks. This is the breakdown of the Basel 1 pillar 1, Basel 2 pillar 1, Basel 2 pillar 1. So Basel 2 pillar 1 had three aspects. One is credit risk, market risk, and operational risk. Credit risk, how to get to there were two approaches. One is the standardized approach, which will delve on in slides to come, and the other was internal rating based approach. Internal rating based approach itself had two aspects to it. One is foundational IRB, and the other is advanced IRB. The other market risk, again with standardized approach and model approach, and operational risk with basic indicator approach, standardized approach, and advanced measurement approach. It will be discussed in the subsequent, because there were a lot of examples I had to give for credit risk alone, and then this video would become long and people would interest. So let's proceed with the standardized approach. First of all, let's delve again into the pillars. And as I said, the first was the market discipline. So, which is having a supervisory approach. This is the pillar two, supervisory approach. Banks knowing if central bank is showing guidelines, if not, they are issued sanctions are there, fines are given to bank. Supervisory, the market that is the supervisory. Central bank oversight is the supervisory approach. Market discipline refers to enhanced frequency and enhanced transparency and market discipline, whereby you have to disclose what have you have done, how you have done, how tier one, what are the elements of the capital tier one, tier two that you include, how are you, which approaches are you following, how are you calculating all that. So all this is followed in this approach, followed by expected, a very important part of the Basel II and a very key element to develop understanding of, so that your future other aspects get clarified, is the difference between expected and unexpected losses. Let's clarify this further. First of all, you can see on the graph, basically it's a bar chart of the losses. If you see, on the x-axis we have the potential loss, on the y-axis we have the probability of default. So as you banks in their during the course of their work, they do have some provisions for losses. They do believe that a certain percentage of the exposure could turn bad, and hence they keep some margin for the loss which they expect, which is called the expected loss, which they expect. The expected losses are covered by IFRS provisions. The unexpected losses, which is they say which is equal to economic capital, that is the one that's catered by the Basel regulations. I will repeat, the expected losses which the banks does keep a provision, and these days with IFRS you have to keep a provision from the day one as you book a customer. Those expected losses are accounted for by IFRS and are reflected in the pricing you charge to the customer. Basel regulations, on the other hand, cater to the unexpected losses and are part of the capital calculations which the bank keeps aside for any unforeseen, stressed environment which you have. And if you see, for the expected loss, if you see the expected loss over here, which the bank knows it will make this expected loss, so this is the provision is kept for the in the IFRS. The unexpected losses is kept by the Basel is comes under the Basel and is part of the capital of the bank. So it says VAR loss at a very high confidence level 99.5%. Okay. So what does this in Basel we do? I will tell you in other subsequent slides. Can Basel for the capital calculations we calculate the worst case loss, and that is why you see this huge the expected losses are there which are calculated percentage of the bank book that a bank keeps. It is the unexpected loss at a very high confidence 99 at a worst case loss. So the worst case loss is a high confidence level 99.9%, which is probability of 1 in 1,000 years of completely customer getting burst, and that is why it is kept at a for the capital. So the first line of defense is the IFRS, the provision which you keep for the customer, which reflect in the pricing. If it's a high risk customer, you price it high, loan high. If it's a very stable customer with great financials, with great management, you charge it relatively less. So let's see the differences between Basel and. So this slide shows you okay, what, because this question comes many times. Okay, Basel, IFRS, what is all that? So this is the slide. Okay, basically Basel II is the capital adequacy. IFRS is the loss loan provisioning. Is the provisioning part. Purpose of Basel is ensure banks hold enough capital to absorb unexpected losses, and this is for the expected losses. Regulatory nature, regulatory because central bank, all the other various regional organization which a bank has to comply by regulate the Basel. While IFRS is an accounting standard, and as part of your financial disclosures for banks and even now corporates, they have to comply as per the accounting part. Loss loan, unexpected loss, expected loss, and risk measures, risk weighted assets, capital adequacy, okay, provision, okay. For key risk measures in Basel, we have the RWA calculations where you have a certain percentage of your assets, a loan to a particular bank, you multiply by a certain equivalence at a corporate, you say, okay, fine, we say 150%, you will give $100 million, you will consider it like $150 million, and then you keep 8% as a buffer. So capital adequacy ratio, you keep 8% as a buffer. Provision, on the other hand, for IFRS, you have the provision for expected losses, which you calculate as far as the staging of the concern. I will make a separate video for IFRS later on. Coming back in for the standardized approach, you can see the standardized approach similar to the Basel one had weights given to the type of exposures bank had. For example, if the exposure were to a sovereign AAA thing, it was 0%. So there's no per se risk weight to it. There's no risk to it. So for example, if a bank were to give $100 million to a AAA, to you can say USA, so that will not be a risky asset. So it will be considered zero. Sovereign A plus 2A. For example, if a country, you can say at this stage, if you say Canada or you can say any European Union country, Germany are A plus 2A rated, it is 20%. So if $100 million a bank has given to the government of Germany or EU, then we consider 20 weight. You multiply this weight to get to know what is the risk weighted asset, the risk equivalent assets which we call. Similarly, if you see over here, corporate A to A plus, if you are given to a large corporate group, or let's say Microsoft or Google, which is rated A plus to A star is 50% rating. So you gave $100 million worth of loan. You will say that you have given you for RW calculations, you will say 100 into 50%, which is 50. So $50 million would be the its risk equivalent risk weighted asset against which you will keep 8% buffer. So 50 into 8 will be 4 million you will keep. So it also standardized approach had weights to different type of assets that were given. Now Coming to understand this better, let's take an example of the pillar 1 method. And like this example you can see, but I will tell you all this in very simplified form. For example, you have a corporate loan rated A bond. You gave 100 million dirhams to a corporate which was rated A, and under the standardized approach for A, you are supposed to keep 50% as buffer. So 50% into the 1 million equal to half a million dirhams you will have as your actual risk weight. 50% into 1 million, which is shown over here, and of which you take 8%, which is 40 million, you will take as your capital. Now we have a retail loan example as well, where you give 200 million to a retail customer. Retail loans typically attract a risk weight of 75% because they are more risky than a corporate. You're more likely to default. So you say 75% into 200,000, which is equivalent to 150k. And of the 150k, you keep 8% as your capital, which is 12. So again, you can go over such examples in the slide. Second is the collateral adjustment. Basel also gave a benefit of the collaterals that were given as part of the coverage. But usually when banks lend, they ask for collateral, which is a very important component, the C component that should be there. So hence, and there are two ways to go around it. One is the simple approach, and the other is the comprehensive approach. Over here, let's take a simple approach. And I will just explain to you I'll just simplify this. For example, if you have given a loan of 100 million to a corporate entity, which is usually 100% risk weighted, which is fully secured by a AAA rated government bond, 0% risk weight. A corporate entity came, they took $100 million, 100 million dirhams or dollars from you, and they gave you bonds, US bonds, as of equivalent amount, $100 million or dirhams to you. So hence, if you see against which you have $100 million, so for a AAA rated country, you have 0% as a risk weight. So hence, this as a as a weight, you will say, okay, 100 million loan you have, against which you have $100 million or dirhams of AAA rated corporate bonds, or for which the equivalent risk weight is 0%. You take 0%. So 0% into 1 million dirhams, which equal to 0, and hence you don't need to keep any separate buffer for it. Having said that, having said that, for example, if you were to do corporate adjustment under a comprehensive approach, in this case, you don't just adjust the collateral, you also adjust the exposure. For example, let's simplify this with an example. For example, you have a loan of 1 million dirhams, and collateral is 800 million in corporate bonds, not AAA bonds, but corporate bonds. So part of the how do you adjust this is that you have the exposure haircut of 5%, and you have a haircut on collateral of 10%, which means that because you have exposure, which is risky, it's a corporate one, it's not risk free, so you sort of over do it. 100 million 1 million into 1.05, because the haircut is 5%, right? This is your exposure, not 100 million, not 1 million, but 1 million into 1.05, because you want to account for the risk factor. This 5%, 10% are given by the Basel. Haircut on collateral, it has given you 800 million corporate bonds, but since it's a corporate bonds which is subject to default, so you also put a haircut. There's 800 million into 90. You don't take 800 fully, you do 800 into 90, because it also has a risk of defaulting. So you both notch up the exposure and notch down the collateral, and it works out to like 105 minus 720k is equal to 330k. Now, of the 330k as a risk-weighted asset, since it's unrated bond, you have 100% as your exposure, of which you keep 8% as your capital. Now, this is the standardized approach, and hence now we go on to the next the other way how to calculate capital under the standardized approach, which is the internal rating based approach. And internal rating based approach itself has two two parameters. One is the foundation and one is the advanced. So let's understand it one by one. Okay, how? First of all, you have to understand certain terms which are very popular, particular, and very pertinent to Basel II capital calculations. One is the probability of default, and this is the likelihood that a borrower will default within 1 year. It's very simple. As banks, we calculate the rating. We can use Moody's or any other in-house system. So that tells us, okay, what is the likelihood of this customer defaulting in the next 1 year. You can have a rate, it can have a rating of 5%, and that 5%, if you're doing the Moody system, 5 as per the Moody system, it is a certain default probability, probably 1% or 12%, based on the type of scorecard you are using, of the it's defaulting in the next 1 year. The other is loss given LGD, which is loss given default. As the name applies, is that in case it defaults, what will be your loss be? Right? The percentage exposure that will be loss of the borrower defaults. Then exposure at default, which is the fine. One is the loss once it has $100 million has gone bad. So what is the loss which you will incur once you have a borrower defaults? In this, you net any tangible collateral which you can recover, any other way you can recover from the thing. Exposure at default, this is the total exposure at the time of default. Basically, for example, and I will give you an example which will clarify this matter. You have $100 million loan which is secured by, you can say, 50 million worth of property. I'm saying it very simply. And so your exposure at default, when the customer default, will be $100 million. To say it simply, it was $100 million loan you took. Probability default could be depending on the rating and the scorecard it got. Loss given default would be you net 100 million, of which if the 50 million property is there, you try to auction it. Out of 50, you get like 40 or 30. Then you say 100 minus 30, and that's a 70 comes your loss given default. We will do a calculation, and M is the effective maturity of the exposure, usually measured in years, while maturity adjustment refers to decline in credit quality case maturity is over 1 year. So if you see, what happens is that, okay, usually we take all the economic laws, our loss calculation for a year. But in case you have a term loan and over time, first year the customer was great, second year it shows sign of deteriorating, third year it deteriorated. So the M factor, maturity adjustment, factors into those factors. So this equation which you see over here, EL, which is economic loss, is the summation of all the various loans which you have. You calculate this separately, the exposure at default, multiply the loss given default, multiply the probability, that goes into your economic loss. The economic loss is your exposure at default multiplied by loss given default and probability default of all the loans in your book. So what we will do to we will let's delve into, okay, probability default. As I said, it means the chance of borrower will default in the next 12 months. How it is calculated? Bank group borrowers into risk grades using into internal scoring system, which I told you could be Moody's, it could be what credit lens, whatever system you are using. They use historical data. Okay, for the advanced approach, banks are allowed by the regulator to use their own data, to come up with how to calculate these such calculations. They don't need to rely on any outside vendor, so they are allowed to. Example, okay, let's take an example. Okay, if 1,000 borrowers are rated B and 15 of them defaulted in a year, so basically 15 over 1.5 is your defaulted, and you can use that as your benchmark. I'm saying it very simply. There are huge calculations that go behind it. Exposure at default, again, as we mentioned, what it means is that, exposure at default is the amount the bank expect to be lost if a borrower defaults, including current loan and the unused credit lines. And as we mentioned, exposure at default is equal to current bank outstanding. For credit lines, bank use internal models to determine. An example, okay, how bank has drawn 800K and has AD 2,200,000 undrawn. If a borrower usually draw 50% of the unused credit before default, so you can have 800K plus 2K 200K into 50%, that's 90K. Let me explain this. For example, if you have a credit limit of 1 million dirhams, $1 million with a client, the client right now is has outstanding of 800.8 million dollars. Now, before defaulting, before his situation deteriorates, usually customer borrow a lot and their increased borrowing increases. So he could, that is why the 50% of the extra unused amount of, so his unused amount, which is 200.2 million, it could be likely that he could draw another zero point 0.1 million, and hence his exposure would increase to 0.8 plus 0.1, that's 0.9. So exposure default would be 0.9. So certain percent of the unused lines are also taken. Okay, they will, bank will draw and will bank will lose that money as well. Again, loss given default, as explained to you earlier, okay, in case it customer loses, so what will be the, actually it's LGD not EAD, the typo here, loss given default, it's LGD not EAD, is the percentage of the loan the bank expect to lose if a borrower default after accounting for recoveries through collateral guarantees and other means. Bank, if you bank gives a loan of 100 dirham 1 million, the borrower default, the bank recovers 700 million through collateral and legal process. So loss given default will be 1 million minus 700k divided by 1 million, which is 30%, or the 0.3. So the bank loses 30%. Now, let's have a comprehensive example involving all that we have learned. All that we have learned. So if you see probability default is 2%, loss given default is 45%, exposure default is 1 million, maturity is 3 years, maturity adjustment factor based on Basel formula 1.1 assumed for simplicity. As I said, it could the situation, you onboard a customer, first year it's the best, second year it become worse, then worst. So that's why that factors into account the maturity adjustment. So as I said, the economic loss is a simple calculation, PD into LGD into EAD. That is, two, for probability default is, as we mentioned, 2%, so 0.02. LGD is 45%, so 0.045, and loss the exposure default in 1 million to 1 million, so total comes to 9k, and apply the maturity adjustment. In case, obviously, the 9k is the first year, second year, what happens? So 901.1 is 9 AD 9900 is the is the uh, is the expected loss for this customer. Internal rating based approach, as I said, internal rating based approach is the first standardized approach we have under pillar 1, which for the capital calculations. Second is the internal rating based approach, which itself is into two part. One is the foundation IRB, the other is the advanced IRB. What is the difference? I will tell you. The difference is, in foundation IRB, banks use their own internal models to calculate the probability of default, while the loss given default and exposure default are given by the regulator. Maturity are also provided by the regulator, maturity adjustments and all. For advanced approach, IRB approach, banks can use their own for all the three aspects, PD, LGD, EAD. So that's the main difference. I'll repeat. For under the standardized approach, there are two for capital calculations. Under pillar 1 of Basel II, there are two approaches. One is a standardized approach, which is similar to what we studied in Basel I, where you just have the every type of exposure in corporate, be it to a sovereign, be it to a corporate, be it to a mid corporate, SME, is given some weight and the weight is applied. And then you have the IRB approach, internal rating based approach, that has two parts. One is the foundation and the other is the advanced. In foundation, bank use their own internal model for the probability default calculations, while the loss given default, EAD, and maturity profile are given by the regulator. In advanced one, or bank has the right to use models, to internal models, to come up with their own figures for LGD, EAD, and PAD. Let's delve into it further. For example, this is the slide that tells us how, okay, now if a bank is using foundation IRB approach, how would it measure the the capital? So in this case, you have, as was told to you in the slide when I showed you this graph, is that banks use the worst case loss. Worst case loss for for to calculate the capital. So in under IRB approach, the capital requirements is based on a VAR calculated over 1 year time horizon at 99.9% confidence level. That 1 in 1,000 years if a loss were to occur. The model underlying this approach is shown in the next slide. Note that any losses beyond VAR threshold are considered stressed capital, which are taken part of the operational risk part. So let's zoom in further. So though this formula which is used over here, it looks very weird and don't get scared. All it's saying is that for the capital calculated, which the bank's using its own approach, we calculate the worst case default under 99%, 99.9% confidence level, which is happen once in 1,000 years, right? So this is all this is the formula is saying, and how it is done, let's delve into it further. Basically, this formula you are aware of, EL, economic loss, is equal to the summation of the exposure default, loss given default, probability default. That for VAR, when you have to calculate the base capital for Basel, instead of PD, you calculate the 99.9% confidence interval for the default loss, default category, right? So you just replace your probability default with the worst case loss of 99.9% confidence level, and as was mentioned, capital is your uh, is your you calculate for the when you calculate for the PD, there are certain aspects which are factored into account by the staging, by the IFRS, by the provisioning, which are your expected losses. So for the capital for under Basel, what will you do? You will have your 99% default you will keep, which will include all the losses, and then you minus the ones that are expected losses. Basically, unexpected minus expected losses. At 99%, they are unexpected losses, and you calculate because it's a if you see the graph, it's a summation, it's a cumulative graph, so you minus the ones that are expected now. So you have the VAR, which is at 99.1 balance, the worst case loss minus your expected losses because they are factored elsewhere in the provisions under IFRS. So now zooming into this further, and just a minute. Okay, this slide I've taken from the FRM course of level 2, courtesy Schweitzer, which I've also written, courtesy Schweitzer. So basically, all it is saying is that there's again, I will just tell you the gist of it. No need to get bogged down into this nitty gritty and the details here. All it is saying is that as the correlation between assets increase, like probability default and correlation increases, the default probability increases, and it's very intuitive because for example, if you have a worst case situation, you have a like a coronavirus issue or a global financial crisis issue, then the correlations they break down and every asset class nosedive, be it real estate, be it gold, be it commodities. In a global financial crisis, the correlations they die down. They doesn't really matter. You could be diversified, but if it's a massive issue, if it's a pandemic or an endemic or a global financial issue, then the correlations break down and almost become 1 or zero point 0.8, and then the default probably 94.4% as it says. Also, this slide also shows if there is like everything is going fine, you can diversify. So if it's correlations are almost every asset is behaving as per its fundamental, then the PD almost there's a worst case scenario almost start behaving like a very company specific factor, idiosyncratic risk it becomes just the company specific factor, no systematic risk are there. Then how banks estimate PD under foundation IRB? This I've told you in earlier slide. This slide is only putting the what I've spoken earlier into perspective. You take the worst case loss, you minus the expected losses to calculate the capital under the IRB approach. Over here, example of foundation approach. Again, it's a very simplified version I've given. Otherwise, the calculations itself takes need of another workshop, because over there, I will just take you an example. I've simplified. Basically, we have just given example of 5 years, and in 5 years, given the number of borrowers at the start of each year and the number of defaults. Then we say, okay, fine, we'll focus on the category 5. This is the category 5, those having 5 rating. So if you add all of them, you will know okay, total borrowers are 4890 and the total defaults are 50. So 50 over 4890 comes to around 1.299, which the bank can use. This is their default history for the grade 5. So in case the banks calculate for grade 5, their PD, they can say okay, PD is when they can go do for grade 5, they can say they can use the figure of 1.02 into LGD 45%, M 25%, 2.5. So these are all given by the regulator under the foundation IRB approach. Next, moving on to the advanced internal rating based approach. As I told earlier, the advanced rating based approach is the most sophisticated method allowed in Basel II for calculating capital requirement for credit risk. It permits bank to use their own internal estimate for key risk parameters subject to supervisory approval. Basically, they see is the bank capable, does the bank have the infrastructure, models, how if the bank has the required personnel and the in the finance functions to carry on all that. And this again includes the same factors are the same: loss given default, probability default, exposure default, effective maturity. But in this case, the bank use their own internal systems to come up with their own parameters. So again, the key features are that bank estimate all risk components internally based on historic data and statistical models. It requires robust data collection, risk management, and model validation, and must meet strict regulatory standards for use. As I said, it's not allowed. The central bank will let you use it once you meet their own specific parameters with respect to is your bank has those models used for capturing the data, calculating the data. Are your finance people, are the finance department qualified enough to do all that? So hence all these are factored into account. Then comes under IRB, advanced IRB approach, banks supply their own estimates of PD, LGD, EAD, and M, which is the maturity adjustment. PD can be reduced by credit mitigants such as credit trigger subject to a floor of 0.03% for banks and corporate exposure. You can't just say zero, there's a floor as well. LGD is primarily influenced by the collateral and the seniority of the debt. With supervisory approval, banks can use their own estimates of credit conversion factors when calculating EAD. So what I mean to say is that calculations of the PD we have done earlier. I gave you an example of how under foundation the PD was calculated. It's calculated in a similar way in LGD, in advanced approach, and for the loss given default and for the exposure default, again banks takes into account its history. It takes the 5-year history. It does statistical modeling of again the same thing. What's the worst case loss they had? What are the in both LGD components? Each component is analyzed based on the history. Statistical models are applied, and the worst case loss is seen. Then the expected loss is subtracted, and hence the we get to know what the capital to be kept. This in this we have the for retail exposures. How are these applied? Retail exposure, I'm just touching them because you should also know this. The two methods are merged for retail exposure. The foundation as well as the IRB foundation as well as the advanced IRB. There is no separate for them in retail. They are all together. There is no maturity adjustment for retail exposure. The capital requirements EAD into LGD into again this worst case loss minus the your normal probability of default. Risk weighted assets are 12.5 if the it's the 8%, 1 over 8%, 12.5 EAD into LGD into law into the worst case loss minus the probability of default. Correlations are assumed to be much lower for retail exposure than for corporates have much one corporate default, its suppliers, buyers, all are affected. For retail, it's not that much. The bank applies similar model across various retail exposure, credit card, mortgage using large historical database. Default prediction models are typically logistic regressions or decision trees, because then they in logistic regression you calculate, okay fine, the person is going to default, okay what are the variables, his salary, his how many years he has been working, what's his age, you do all that calculations. The PD, LGD, EAD for each segment help determine the capital requirement, expected loss provision. Retail exposures benefit from pooling because you don't calculate for, unlike a corporate where you calculate for each customer individually, ABC LLC, ABC Limited, XYZ Private Limited, you do for individually. But for retail, you usually, not usually, you pool, okay, your credit card exposure, you see on a pool level what's the default list, what is the exposure at default, how many have paid. On a pool level, you pool them, and hence people usually benefit because it's not individual one. allowing their benefit from pooling, allowing the use of behavioral scoring and large volume analytics. So this is, as I said, this is the this is the first lecture on Basel II. I'll follow with the second lecture, which will be on the pillar 2 and pillar 3, plus the two approaches of pillar 1, just so that the video is concise enough for people to watch. So thank you, and kindly subscribe to my channel. Thank you.